Thank you so much for coming, Valentin. This is our second time, isn't it?
Yes, it's always a pleasure. Thanks for inviting me.
Well, today we're going to talk about yesterday and then also about China going forward. But let's talk about yesterday's data. That was like the most important data of the week, GDP.
Yeah, it was a big...
Did it surprise you? But the stock market showed a rally?
Yeah, again, it's surprising on the surface, but if you look at it, you can find reasons why it is the way it is. So GDP, first of all, minus 1%. Economists expected minus 0.5%. This is the first revision. The advanced estimate was plus 0.1%, so now it's down 1%. So what happened? The biggest change was in private inventories. So they, instead of only going down 0.5%, they went down, no, 0.6%, they went down 1.6%. And the way GDP is calculated, if companies produce something, even if they don't sell it, it shows up as inventory, so it's a plus because it's gross domestic product, it's production, right? So in this quarter, in the first quarter of 2014, companies just sold off their inventory and didn't produce more. And why is that? You see, every single time there's an earnings announcement, the company will say, well, this quarter we did okay, but next quarter is going to be rough. And you see this practically every single time from companies like Cisco System and IBM. They don't have a very strong outlook. So if you're a company and you don't have a strong outlook, you're not going to churn out new products waiting for people to buy them. No, you're going to sell off your existing stock and wait what happens. Now on the consumption side, consumption was up 2%, roughly unchanged. That's okay, it's not great, it's not okay. Now, will that change to actually entice businesses to increase production again and therefore boost GDP? No, I don't think so. Why? Because consumers don't save much. If you don't save, you have to borrow, but also borrowing is not really happening. Credit extension by banks to consumers is very low apart from student loans, and that goes into a very limited sector of the economy. So I expect that number to be stable. And you say most people expect GDP to go up in the second quarter. Okay, the weather is going to be better, but even that should have been taken into account with a seasonal adjustment. So I don't really see a reason why GDP should go up. Now the stock market, completely different animal. There's a couple of factors influencing it. So the new normal, it says that, okay, economy doesn't matter, but if the Fed is printing money, the stock market should go up. So that basically was the way things were working the last 5 years. Now sorry.
No, very well, very good analysis. Continue, because I don't want to stop you. You answered all my questions that were in my head already about going forward. Why did this happen, stock market? One more point.
Yes, so the point about the stock market is, so now the Fed is tightening, so stocks should go down like they did in 2010 and 11 when they stopped the QE. However, there's another type of Fed buying stocks, it's the companies themselves. So according to Capital IQ, they plowed in 160 billion in the first quarter, buying back their own shares. How does this work? The company borrows money, buys their own shares, share price goes up, shareholders happy, executives are happy because their compensation is tied to the share price. And this goes on until the companies are over-levered and have too much debt, which, by the way, on a net level, so if you subtract the cash from the debt, the net debt is at an all-time high. So yes, companies have a lot of cash, but they also have a lot of debt. So this is essentially margin buying and speculation by companies, not capital being put to productive use for expansion projects in the economy. So again, in the medium to long term, where does the future growth come from?
All right, we're going to go from America now to China, but last 10 seconds I was told. So you need to tell me why everybody is thinking that China is slowing down the whole global economy as well. Is that true?
You mean I have 10 seconds to answer
Yes.
That's a bit
because
short.
we really gave a lot of time to America, but it was important. We needed to do that wonderful, perfect analysis. That's why I needed you to be here. But let's talk about China.
China, in a nutshell, so they have blown up a massive credit bubble of epic proportions, $17 trillion. worse than subprime. The growth miracle is not a miracle. If the US had pushed in that much credit in the system in the last 5 years, they also would have grown at 7%. So it's not a miracle. Now the leaders in Beijing, they want to deflate the bubble, and like all central planners in the history, if you look at Japan in the 1990s, if you look at Bernanke in 2006, they say they can manage it, but they can't. So GDP is already slowing down, property prices are going down, and there's really not that much they can do about it.
The housing, well, let's take another extra bonus from my director. Is that really where it is, the concerns in China?
Yes, yes, and there's a couple of things happening. First is the discounting. So yesterday the Wall Street Journal reported that in some places if you buy one floor you get one floor for free. And then the chairman of the biggest developer, Vanke Group, he came out 3 weeks ago. He gave a private speech, which was leaked to the public, where he basically said the whole thing is a crazy bubble, has reached Japanese and Asian proportions in terms of how much Beijing or Hong Kong or Tokyo were worth in terms of US GDP. So Tokyo was worth 63% of GDP, and Beijing is now worth 61% at the peak. So if you sell Beijing, you can buy 2/3 of American production, and that's just one indicator that shows bubble levels.
Shows the bubble levels. Thank you so much, Valentin. Perfect. Both we covered China and America. China, we need to cover more.
We need definitely next time. We need
next
to do
time.
more.